over the past few years, we had a lot of good scalpers in the podcast, people who are scalping every day, making a living in the market with the lower time frame strategies. And I thought it'd be good to combine these advice together so you can kind of learn how they really do it and what things these scalpers have in common. So hopefully it's going to be good value. We put together a 1 hour masterclass. It's going to focus on all the things about scalping, in-depth stuff that you don't really see elsewhere on YouTube. Hope you like it. Comment below what your favorite advice, and we'll jump right in.
Right, so we have to recognize what's dangerous for our expected positions. And then if we can avoid it or step aside and wait and trade the reaction to the news, within 5 minutes, you find yourself at a level that you would expect the market to maybe slow down and, range for a bit. And in that range, you can start to implement your next steps. And so it's not about chasing stuff. It's about planning the next step ahead and waiting for the best place to trigger. So first step first, check the calendar. Second step, we do the top-down analysis. On a day like this here, top-down analysis, at some point we would have walked up to the computer and started measuring from a previous swing. I think this was last week. We had a news event. And so the news event itself created volatility. If we measure just that volatility using the boxes, it delivers 3 to 4 boxes on its own, right? So this current swing was 4 boxes, and then a little bit more, a half a box. We retraced. All this kind of stuff is a way of thinking through one standard deviation at a time. And that's all I'm trying to do. That's all I'm trying to teach the folks to do, right? To think of the probabilities of that next swing. So basically, the current swing ended. It was followed by a retracement, followed by another, extension or a continuation of some kind. Right? And by measuring these moves, we can expect or anticipate the probable outcome, right? So it's just keeping things in perspective and lowering our expectation. So once we have your top down and your news, you start to drill down into today's plan. And so that's where the Sherlock Holmes, you start to have a deduction, kind of a detective mind, right? So if this has already taken place, I'm left to do this, and this. Or if the market has moved 60 pips and we know on average it does 90, maybe I'll do 30 while I'm here, right? So I'm just trying to think of what an average is compared to what I'm walking into. How much off the average am I? And what do I have to do to get there? And so it's really just a game of thinking one step ahead of everybody else. Everybody else is trying to catch the current move. I'm trying to measure it to see when it ends. So a lot of what I do ends up being, because of time of day, counter trend to the norm, right? So people here will see lower highs, lower lows. It's a downtrend. And here I show up at 8 o'clock playing the bullish side. And it's because time of day compliant, I expect the day to be near finished. And if you look at a daily candle, there's usually a wick there. And this is where that wick comes in. And so it's usually a time and a location that aligns and I take advantage of. Right, so timing-wise, 8 o'clock in the morning, which is 10 o'clock Eastern, I measured the past. I have an expectation for the future, and it's within my game plan. It's within my 36 pips of expectation, right? It's not going to go further than 36, and if it is, I'll deal with it in the moment. And so I have this plan, and I have plan B. And more often than not, I end up executing plan B. Right? And so this is the part that people don't expect, right? The market should do this, And if it doesn't do that, they get upset. And so what we do is we think more in terms of could, right? The market could do this. It could do that. It could do this, this, and that, and the other. So by using the word could, you're opening the door to a lot of possibilities, and you don't get upset if you get plan D delivered or plan F or whatever it is, right? There's always an alternative to what should happen. And so the people that chase the market are chasing something that should be happening. And usually you end up buying at the very, very top or selling at the very, very, very bottom, because what should be happening is just not happening. And so in this elite scalping course, that's kind of what we do, right? We measure the previous moves. It sets up the stage for a high probability next leg, which we take advantage of. Right? So it's not really elite or scalping. It's all about probability assessment and positioning. Oh my God, I'm wrong. Everything's going the wrong way. Instead, it's more like, aha, here's a opportunity to fix a problem. And so it's really a way of thinking things through, right? This should have bounced. Instead of bouncing, it's going through. It's a breakout or a breakdown. As such, we have to repair it. And so we teach how to repair bad trades or trades that go the wrong way. And so you're either making 3 pips when things go the way you planned. And if things don't go the way you planned, when things don't go the way you planned, you find a way out. You average your way out. You use a little bit more money to lessen the pain on the exit. All right. So when things don't necessarily go your way, it's not all bad. It can be less bad by spending a little bit of money and engineering an exit that is not so damaging. Think of it like an insurance company. Right. The insurance company does not stop accepting your payments just because you put your car in the ditch. They actually expect you to keep paying. Right? So just because you're approaching the 36 pip stop, you are expected to keep winning, keep making 3 pip trades.
A lot of people would call this averaging down, like you would just like add money to a losing trade. Tell me how that's different. I know you have a plan about it and you can have measures, but explain to me how that's different than averaging down.
Yeah, so the averaging down so what you're referring to is losers averaging to losers. If that's the approach, then that means the first trade has to have been closed and you booked it as a loss, and now you're trying a second time or a third time. You're using more money to chase that original trade, which is booked. Right? That is no longer work in progress. It's an actual physical loss. What I chose to do is take my 1% for that original trade and break it up. And so I'm averaging in my original 1% the same way that I'm hoping to average it out. Right? So no longer am I chasing a losing trade. I'm adding to a working trade. Right? So it's not booked as a loss. It remains 0.25%, and then it becomes 0.5%, and then becomes 0.75%. And then ultimately, if all push comes to shove, I have the entire 1% at work in one box. And then if things still don't go my way, I'm allowed to repeat this process 3 more times. So ultimately, if everything went wrong, or if that's part of the plan for that day, I'm willing and able and allowed to spend 4% to build a position. Right, so that's layering in a box upon a box upon a box upon a box, 16 clicks. So that's 4% of my account, 16 times 0.25%. And then in the end, I'm looking for an outcome. I'm looking for one move that averages out. I don't purposefully chase the top or the bottom. I just happen to be here when we make it. Right? It's time of day. So I happen to participate at the same time every day. But I can see the fear that people have with averaging in. And I think part of that misconception is not knowing the difference between drawdown and a loss, and then putting it all in one basket versus spreading it out 4 or 5 clicks, the same amount, right? So one is kind of a dart hoping to be the bullseye, and the other one is more buying opportunities to be right. That's the flip side of swing trading, right? If I put my 1% with my 2-to-1 target and I have a, for example, 36 pip stop, I would be looking for a 72 pip goal. The average day on the euro is not even 72 pips. So right away I have to think, okay, I'm in this trade for a couple days. Right? And so the flip side to that is between now and then, I could be making 3 pips, 3 pips, 3 pips, 3 or 4 times. You know, I can collect coins while I can see the steamroller coming my way, right? I can keep running back and forth across the street while I measure how far away the steamroller is, right? So it's because we measure the risk before we jump in. And if things go wrong, if things go beyond our control, we know to start peeling out some of the trades. So when people assume I'm going to lose 4%, that's if the market keeps going the opposite direction for 8, 9, 10 boxes. You know, it's extremely rare. I've already watched it go 4 boxes. I've measured this, hopefully in line with a bias. So this is a move with an expected outcome. I'm playing into that move. I know where the drop dead limits are. And so by not allowing to go near there, we tend to come out ahead. It's an averaging game, right? So I'm just teaching the folks to measure the past, understand where we are right now, and what the potential is for the next couple of hours, not the next couple of days, right? Because I can't tell what happens between now and then. The news calendar gets in the way, real life gets in the way, geopolitical stuff gets in the way. And so as a day trader, I have a better consistent outcome if I can judge the next hour or so, and then that's it. And so with that comes the possibility that I have trades stuck open. All right, so I'll trade my couple of hours and I make 3 pips, 3 pips, 3 pips, and the trades that don't close, I end up managing them in a group, targeting break even. And typically, I will leave everything as is and rely on the stop loss and the existing target. Other times, if I see myself going into NFP or something, I may book half off. I may book all of them closed and take the losses. Other times, I just leave everything as is. Right? If you look at the big scheme of things, if you take a 30-foot view of the market, go to the daily, go to the weekly, go to the monthly. A lot of these news events are just a bump on the road. We happen to see it from the 1-minute chart, and it looks like an earthquake, but it's really nothing in the big scheme of things. Right? So if you can figure out the bigger picture and survive on the 1-minute chart, you're okay. Now, what we're looking for is a price and a time cycle. And the same thing is present on all the markets out there. It could be futures, is either make 3 pips or do anything we can to not go to the stop loss. And therefore, breaking even becomes very appealing. And we spend money to get there. Just like an insurance company spends money to lose less, right? So it's the same psychology, except it takes a little bit of training to think things through from the opposite side. Because if you think about it, I'm training myself to play bounces, and once in a while there will be breakouts. And the breakouts are problematic to this strategy. Right? So if I'm expecting to go into drawdown and now there's another wave of drawdown, these breakouts in the wrong directions become more and more and more important. I have to deal with them. So this is why breaking even is so critical. Right? It allows me an exit and a fresh reset, a chance to do it all over again. So, but yeah, being upside down is not as big of a problem as we think, because the target is achievable. And if we can't achieve the target, we can look for break even. We can engineer break even. But yeah, the strategy works. It's a matter of discipline, just like anything else out there. And at the same time, discipline with this method is not rule based, right? It's internal. It's the way you perceive probabilities, right? It's the way you think things through. There's no way you can program this strategy and let some robot take care of it, right? Even if you think you're going to be managing the robot, it's just not like that. There's too much freedom almost, right? So you're learning to show up every day to rein things in, to expect less and to be content with less, right? So instead of chasing that $1 million by the weekend, you expect to have consistent results by the weekend. In early 2000s, the pinnacle, the top of the pyramid was to trade other people's money. And now all of a sudden, that prop business clued in and they brought that forward. Oh, you want to trade our money? You can rent it. Right? But it used to be you had to work your way to trading other people's money. You had to have a track record. You had to have experience. And now you're gaining the experience with their demo accounts. You could do that for free. And so get the experience and then use them as an insurance policy so that you don't risk your money. That's the way I approach it, right? These $100,000 accounts save my $100,000. And so if I blow up the prop account, if I breach that 5,000 limit, it's only cost me the prop account. I still have that 5,000 in my account, right? It's an insurance policy. It's a mind game. But yeah, at the same time, it keeps the accountant happy. So I trade probabilities. And so what happens, I'm not necessarily waiting for the confirmation. I see the market unfolding. I see the trade set up. And because I've seen that same setup, 80% work in my favor, I'm willing to bet on that 80%. And so I don't need that confirmation bar, which is half of my 3 pips. I just trade preemptively. And basically what I'm doing is I'm trading the next move, right? So I'm trading like Wayne Gretzky played hockey, right? If I'm selling, it's because I think the market will eventually go down, even though it might be going up right now, right? So it's much like a casino is postponing gratification, right? It's okay to let the guests win right now because in the end, the house will win in the end. When you're swing trading, you're relying on one exit and you don't have control over that one exit, right? It's predefined. You have your 2-to-1 risk to reward ratio and you don't interfere. What I do is I define the risk and I interfere with what the market is trying to do. Right? I change the outcome by changing break even. All right, so we've just made some money there. We just closed a couple of profits. Yeah, they reached a 3-pip take profit, and so we booked those profitable trades, and as such, the break even moved lower. It's now reflecting breaking even for the remaining 2 trades. And see that green candle there? I'm recycling the 2 trades. Boom, boom. All right, so I just took back the same 2 trades. Okay, so I made a little bit of money. I'm putting the 2 trades back on in this box. So the money that belongs here is here. And I'm hoping to basically recycle the exact same trades, redo what just took place. All right. So it's like rinse and repeat. All right. If I'm wrong, we will test the next level of resistance. And that opens me up to clicking a couple more trades. Right. I can only have 4 clicks per box. And so I need to be recycling the trades like we did here over and over and over and over and over. So I start my day with the schedule in mind, and then with that scheduling thesis, I find myself near the top or near the bottom of the day at the same time of day. And so with this information, I realize I don't have much more to go. I'm here for the North American session, which is the end of the day. And so I'm here to fulfill the average daily range. If I can fulfill the average daily range, odds are the day's over. Like the volatility will shrink away. And that's typically what will happen. There's times during my 2 hours that I find myself having to reset my bias, but odds are it's one bias for the whole 2 hours. It's also very rare that I'm here for the full 2 hours, right? So the 2 hour window is there, but I don't use the whole thing. So more than likely, I'll find the bias from the top-down analysis. I'll trade that bias for 30 minutes, an hour, and then I walk away. If I end up sticking around longer than that, I find myself having to change my mind a few times during the day. Right? It's every one of these cycles here, every one of these up legs or down legs. It's either what I'm trying to do for the next 2 hours, or it's the opposite. It's counter trend to what I'm trying to do for 2 hours. Right? I'm not here forever. I'm only here for the next move. And as we speak, you and I are trading this as the next move. Right? This is what I'm building a position for. All right? So I'm not looking at this. I'm looking at that. And then if I'm wrong, I'm looking at this area here to see if we break this, maybe I'm wrong and I need to average out. If we bounce off of this, I'm probably right and I'll be making my money on the way. Right? So it's a seesaw, like a teeter-totter. And I just choose which side of the seesaw I put my money on. The proof has to be there for me to change my mind. I don't want to flip-flop. I don't want to play ping-pong, ping-pong. I want to play ping, 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 and then switch to pong, 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 pong. And so it's ideally, I know when I'm wrong if I've gone into box 3. Right? Boxes 1 and 2 are reflective of an average move. Boxes 3 and 4 are beyond an average move and usually call for, a break even. And so it's the security blanket. It sets the stage for me to understand what's taking place. What do I need to do here? Because we've moved 4 boxes. The people that don't track this kind of stuff, they think the market's on the way to the moon. Right? Oh, it's on the way to the South Pole. It's not. It only moves average upon average upon average. It's an average day. Sometimes it does more, sometimes it does less, but it doesn't do 5 days in one afternoon. All right, so this is why we have to keep our mind grounded. Your idea is flawed, right? So you have to highlight where this is not working anymore before you click the mouse. And so for me, this not working anymore is 36 pips. And inside of that 36 pip zone, I engineer what I'm looking for. If I go and buy a new dishwasher tomorrow, I'll figure out how many clicks I need to pay off that dishwasher. And then I'll do 20 or 50 clicks per day and leave the casino. Right? I don't want to blow my luck at the casino. And so this is it. If I push my luck beyond 2 hours, so if I'm now trading when the volatility is shrinking, I'm holding the bag and I really don't know what's coming next. It's now up to the environment right? If I trade that 2-hour window, I'm trading a neighborhood that I'm familiar with in. It's like driving to work. You leave the house on schedule, you follow the same road, and you get to work on schedule. And if anything creeps up in your path, you'll still get to work on schedule, right? You'll figure it out. That's what trading on schedule is, right? I expect normalcy, but I deal with the facts. I started by focusing on the time of day to minimize risk, but then I realized that same time of day gave me the same paycheck. And so that became potential average yield, right? So some days it's $50, some days it's $300, but over time it's average. And it's within that 2-hour window. My biggest losers always come from the trades that I take before my 2-hour window. So if I show up to my computer an hour early, those trades will cost me at the end of the day. If I trade within my 2-hour window, I can leave the casino problem free. So it's reviewing the mistakes, reviewing the journal really opens up, what your potential is. And then after a little while, you realize, hey, I do the same work every day. That becomes your paycheck, And I'm not looking to reinvent the wheel. I just want to make it go around. And that's where the top-down analysis came in, right? The top-down looks at two groups of people. It looks at the daily traders, and it looks at the intraday traders. And then I try to align the two together, right? I try to see what the investors are doing with the day traders. If we have the same ideology, the same thesis for today, it tends to help me. It lifts all boats.
In the beginning, I think the industry has lied to us. Everybody starts being told, hey, start on the daily chart and you'll have better results there, right? But they also neglect to tell you you're going to have bigger losses. And so over time, you find your way working your way down to like a 1-minute chart where you can actually afford to lose, right? So it's losing on the 1-minute chart is very, very different than losing on the daily chart. And here, if I'm in front of a 1-minute chart and I'm witnessing the loss taking place, I'm in control. I can stop this at any time. I don't have to watch it go to 36 pips. I don't have to watch it hit my stop loss. I'm in control. And even as the market is moving, I can change the environment by adding an extra trade or 2 extra trades. And now all of a sudden, I'm not only in control of 3 trades, but I'm in control of the average of 3 trades. And that's the line that you're moving. You're putting that line closer and closer to the current price. It becomes your break even. All right. So now you're controlling where your exit is. You're not letting the market tell you where your exit is. And so by trading like an insurance company, by pushing back against losses, right, and taking in tiny, tiny, tiny premiums all day long, you can profit at this. You need to manage the losses. It's okay to lose. It's part of the game. We're expected to lose, right? But we need to control how big those losses are. And if you find yourself revengeful, that's 3,000 years of evolution. If somebody rips you off, you need revenge. And it's in your DNA. It's in your DNA. You're learning to lose. You're learning to become a professional loser. You're learning to become a monk, right? So taking a 10 or 15 pip loss, you have to go back, reverse engineer that loss, figure out where you went wrong, and then tell yourself, hey, that's no big deal. That's 4 or 5 wins. And then just get back on the horse and create those 4 or 5 wins, right? So it's not one big loss and then one big recovery. That just creates mayhem. We need to control the loss and then recover that loss slowly. Stick to your program, stick to your process. My psychology changed. Now I start my day with 2 pips. Hey, success. And it's easy to keep going from there, right? If I wake up in the morning and I turn on my computer, it's, oh man, I lost again. It's hard. And this is what created the solution for me. And I did not design this. This was taught to me, right? And so as long as I heard it from the horse's mouth. I could trust the people that delivered to me this information. So it allowed me to step outside the box, the risk to reward ratio, the daily chart. It allowed me to step outside of the norm, and trusting the source of the information was really, really important. And then practicing it in real time. So in a demo account, but in real time, the same 2 hours that I was hoping to work in, that sped up my learning curve, right? Instead of wasting 18 hours per day on random markets, I focused 2 hours specifically on just what I'm trying to do. And then I went about my day, and that sped up my learning curve. And so the industry is designed, you've been invited over for dinner with a big smile, but they never told you were going to be the meal, right? So you end up on the table or on the menu and you don't know. You have to make that choice in real time along the way. And every day you choose to lose when you choose to lose, not when the market tells you to, right? And that's important. It's a choice we make. If I'm not using boxes, I would rely on Bollinger Bands. They're the next closest thing, right? So they allow me to measure volatility over 20 bars or 12 bars, whatever you select. And so this is kind of a similar idea, but I would find a way to measure time, because we've been lied to. All this time we've been told you cannot time the markets, and I beg to differ. Right? This is it. I'm proving it to you here. We can see when the next move is about to come because they're standard moves. And so you can anticipate. This is a lot like forecasting the weather, right? If I were to ask you where you live right now, what's the weather next week? Your success, dismal, almost negative, right? You're going to lose every time I ask you the question. If I ask you the same question, but now I say, what's the weather next hour? Your success goes up. And here I am looking for the weather in the next few minutes, right? And so my success is extremely high. And because I limit what I look for and how far into the future I look for it, I know when I'm wrong and I can stop it. Well, enough. That's it. And then, right myself or get on to the other side or do whatever I need to do. It's a step. It's a logic kind of step, right? You do one thing, it leads to a yes or no answer. You do something else, it leads to another yes or no answer. And then eventually you run out of options. That's box number 4. The market has tricked you. That's it. You lose for today, right? But that's not the norm. You typically would leave the casino with money, right? So we're here to fight every day and to overcome those losing days, right? The losing days are there. They do exist. I lose like all the time. I took losses today. I took a handful of losses today, and this is normal. The problem we have is we cling to our losses and then we forget that it's only a few trades to make them back, right? So the internet is teaching everybody to take tiny, tiny losses. Take small loss, take a small loss, take a small loss. Eventually you'll be right. Well, what happens when you take a small loss and a small loss and a small loss? When you are right, you build back your losses and you break even. You can't make money taking losses like that. You have to allow some space, a little bit of drawdown to get the job done. Right? You need space to get the job done. A tight, tight, tight stop is exactly that, a tight, tight, tight stop. And so my game here is to make tight, tight, tight profits with a big stop.
You said it right there. People think they can go into the markets and just trade and take money, right? You heard the stats. 95% of day traders don't make it. You know why? 95% of the people don't make it to professional sports teams. If you're going to be great at something, if you're going to be great at trading, not any Joe Blow is going to come into the markets and just extract money from the market. It's just like anybody could go into a casino and try to make money out of a casino. You have to go in there with a plan. You have to be a card counter or something like that. Take the best games possible. Game theory, wait for those opportunities. And that requires so much discipline. That requires so much patience to be able to fit yourself into a business plan. So a business plan for me is a successful model of trading that I could look at the plan and say, is this my product? I have to find this product, just kind of being a business, making money. For me to make money, and I'm a scalper, I look for 2 setups in the market. And it has to set up exactly like this, because this is my business plan. And if I take the setup, I look at what the next step is. What's in the business plan? It says, well, you move your stop up this amount, place your stop here, let it run, watch the stochastic 63. I have things that I'll explain to you in a second. But it's very important to stay within that barrier, because if you're just a loose cannon in the markets, and getting back to why do you need anybody could come into the market and make money, you can't. You will be eaten up and chewed up and spit out, because the financial markets are the biggest industry in the world. And a Joe Blow going in is like being a basketball player and you want to make it to be the pros. You want to make money at something, then you better be good at it. And the market will, it knows where to go. The algorithms, the things. It's not as easy as you think. Oh, I have to get in. A lot of people say, I just have to get in and get out, follow the trend and stuff. But, I've done this a long time, and now I've come down to a point where I realize less is more. Wait for the opportunities. Be there in front of the opportunities. Another important thing is if to be a trader, full-time trader, which I'm a full-time trader. It's very hard to do because you have to be in front of the computer, pretty much most of the day. I mean, there's different type of traders. We have swing traders. We have, day traders. We have scalpers. But for like a scalper looking for certain setups, you have to be there for the setup to be and to be able to take the setup when you see it and get out. When you're not in front of that time to put the time and effort in being a professional, all right, being a professional is being successful, to be able to get up there and do that and be focused enough to take the setups, don't goof off, don't overtrade, don't gamble, all these different things add to the formula. Then you become successful over time after you go through that, learning how to. So that's what a business plan does for me. It identifies everything, keeps you it's a proven way that something works. And if you follow the business plan, it will work. If you go outside the business plan, it won't work. If you start to gamble, this is my business plan. Basically, I live by a business plan. So sometimes I'm so scattered. I have a lot of stuff in my head about trading and stuff, but I go all over the place and I'm always looking for things. So it's very important to me that I define everything for me. It's my personality type. Just other people have a different personality type and they're able to handle things. For me, I got to really put everything in a flow chart. That's what I did for you tonight. Today I actually made a flow chart, which makes it easy for people to get into a trade. And what this is going to do is going to prevent over trading, and it's going to prevent losing, basically. All right, so let's jump on here. Order, of course, this is, I guess you guys could pause the video and kind of write this stuff down. Order criteria, profit exit criteria, all these things need to be figured out as you're trading. You can't be just going into the markets and not knowing what's going on. So all these things should be defined before you get into a trade. How you're going to get into a trade. What are you looking for? How are you going to get out of a trade? Automatic stop criteria. Do you have one? Where's the stop go? What's the risk management of the method? And what I mean by that could be a little bit complex, but what do we want to add shares, take shares off? How and when do we want to increase the position size? How to set up your charts, tools of trade, balance. I don't worry about the balance thing. That's from an old thing here. And then these are my rules. And this is, again, everything about this is an important thing. I know this works. This is what I do every day, So I'm very comfortable of teaching this. I'm proud to teach this. I teach this because I enjoy, like you do, travel and freedom. And I feel like people, you get stuck in the grind You know, I mean, you have dreams you want to do, and not many people can achieve those dreams. And this is kind of a path that you could achieve those dreams. If you have the discipline and patience, you can make something out of yourself as a trader. But you have to be the best. You have to be the best you could be. And to be the best, you have to be organized. And these are the setups. I want to show you these setups today. Very easy to say. I know we have limited time, and a lot of people don't know about the stochastics and stuff. We went through a lot in those videos, and it's all based on the same thing. I mean, I'm truly, really love this style of trading. It is a very successful. It's the only way to be successful. I sit in front. I'm on the mic all day, so we're talking. I'm doing news. I'm talking to markets. I'm answering questions from the people in our chat room. I see people. I trade stocks, options. It's a full thing going on here. It's a lot about education. I love teaching trading. I love people being successful. The onset of the new prop trading. A lot of prop traders now, use the system to kind of qualify, and I want people to be able to be successful doing this. So earlier I said. And I just came up with this, and I think it's ingenious, and I want to mention it, and hopefully, it catches on. But I've been working on a service to try to get these super signals out. Remember, super signals like a combination, and I think these things are worth tons of money. Because earlier you said time is money, and do you want to sit around if there's only 3 setups a day, right? But what if those 3 setups gave you 20 to 30 points? I mean, you can still have to deal with that. And what's more important for you, your time or you waiting for the setups and taking them and making money? That's a good question. So I said, yeah, I don't want anybody missing these setups. I'm in front of the computer all day. I'm on the radio all day. Let me set up a thing where I send out the super signals over my phone. So I set up an app, Voxer Network. You ever hear of Voxer? So we have a channel for super signals. So I have so when I do see that trade and people are not, I said, this is an important trade. I send out the alert here. So here's an example of the alert.
All right, it's 12:18 p.m. We just came off the lows, and I'm seeing a 14.3 divergence here at 54.55, 54.54 buy side divergence. Your stop has to go right under 54.50, the lows of the session. Very important to have your stops in at this point because the weakness is in. But there is a slight 14.3 divergence here. And we're just seeing where we're going to go from here. It is 12:18 p.m.
So I'll send this out, and then I'll send a picture of it, I'll send a picture of the chart in the setup. That way, people are not missing it. If they're like in the other room, they could run to their computer. These setups don't move. Etienne, you have to send me your name. I want to put you on this, so you get the alerts. You're going to see these alerts, and they're the super signals. I mean, they're the things you don't want to miss. So I really concentrate on that during the day. I really believe in this. Calling the markets and just watching the craziness that's going on in the world is how else I keep busy. It's cool. It's I don't think, many people do that. I think it's important to be in front of the computer, and not everybody can be in front of the computer for these setups. So, well, I'm just going over some of these, everything. This is kind of the ideal setup. And if you find a channel, just to help people out here, if you find a channel, look for a divergence in it. That's going to be your channel breakout. Well, every single time, if you have a recognizable channel, which we talk recognizable, we're talking about a defined channel, 1, 2, 3 pattern, and you have the end of the pattern, you have a low and a lower low and a higher low and a stochastic. 9 times out of 10, that channel will break out to the outside. I'm not predicting how far it's going to go, but I do predict that if you buy the low and you have a divergence on a candle, it will break out of the channel. So we know there's a big move here. And that happens so often. And that's what we just have to wait for. And in every situation, just kind of very important, place your stop right on the candle low. It's so easy to do that. I wanted to go into coil divergences. There's a lot of divergent stuff that I do, but that's about it. And the flags, we talked about that rotation. If the 60-10 is embedded and you have a fast rotation, that's called a bear flag. And it's much different than, this is a scientific, mathematical way of, looking at a bear flag. It's not about just looking at the flag and saying, oh, it looks like a bear flag. I know that it's a bear flag because I know the internals. I know what I'm seeing on the internals. And it's very easy now to identify a real bear flag. Oh, that was the Voxer network. I put that on there just to let people. So I'm sending out those alerts, but you guys hopefully get some information on that. That's the key to success in trading. If you find something that works, as a guy told me the other day, he says, I'm not going to try to reinvent the wheel. You know, you got something, that's why I'm coming back. You know, I just had a session with one of our members, and he came, you know, he went on his own. He was with me probably in 2008, he said. 2008. I was like, and it was great talking to him. We talked for about 2 hours. And he goes, John, he goes, I always watched you, I always respected you, you know, and he was from the South. He had this real thick South accent. And he goes, but I thought I could do better, you know, and I wanted to go do it myself. And I said, I understand that, you know, everyone needs to go do that. Everyone needs to find their path in trading. It's very hard to come in and say, oh, I'm going to use this guy's technique. I was the same way. You know, I was the exact same way. I did not want to trust someone else's method. You know, I needed to find my own method. And I think a lot of traders, because you know, that's what I do. I talk to traders all the time. So since 2008, since I've been on the air, I've talked to thousands and thousands of traders, and most of them are just, you know, they're always searching for their way of doing it. And that's okay. I mean, after a while, you become kind of zen in the market where you kind of realize there's no fighting. I'm not going to change anybody. I could teach them what's going to work. And eventually they're going to have to realize that really did work. And that was the best. You know, there's nothing better. You know, there is no holy grail, but there is close. And what makes this system, what makes this trade so good is it has a defined stop. All right, a defined stop. It's very easy to recognize. All right, it's extremely successful, and it keeps you out. The most important thing, it keeps you out of the market most of the time, because more you're in the market, the more you're going to lose money, unless you have a spot in the market that you really understand what's going on. Now, I'm going to give you guys a secret here. I developed these 4 stochastic bands. I didn't develop them, but I put them together in a way that I did some calculations, and they all represent a different time frame. So when I'm watching these stochastics, and it's just the D line, I know what time frame. This is actually the 14, this is the 9-3. I'm going to tell you what they are. 9-3, 14-3, 44, and the 60-10. I agree. 1 minute is extreme. Think of it this way, though. Think of it, first of all, when a new trader comes on, all right, instead of trading with their own money, they're trading with someone else's money. It's very easy these days, any way you want to do it. Then you teach them how to trade. You know, then they're not risking their own money. And it's not that you want them to learn on the 1 minute time frame, but it's like I had a coach and in baseball, and he'd throw ping pong balls at us when we'd had to hit it with the baseball bat, ping pong balls. It was such a small thing that it was harder to hit, but when we got to throwing the big balls, it was easier to hit them. It was a great strategy. And same thing, if you could identify a good divergence on the 1 minute time frame and get a small little, you know, this works better on the 5 minute time frame. So I'm trying to show you the 1 minute because a lot of traders want that action. And you have to be, and it's much harder. Like you said, the 1 minute is very hard for beginner traders sometimes. They're too excited, you know, you can't all be as calm as I am. I'll tell you a fast story. I might have told this the last time you were on. I was on a year or two years ago. During the tech bubble, everyone was trading. It was like recently in the recent meme stocks, in the Reddit stocks and stuff like that. You know, everyone started trading. It was holding GameStop and stuff like that. It was kind of frenzy and meme-ish. They called it. I guess they called it. How most people blow up. It's very hard for beginners. So I ended up opening up a few trading accounts, Schwab One accounts for 3 or 4 of my friends, and we're all trading out of my apartment. It was like 96, 97. Everyone was in the market. I opened up accounts. I was doing real well. I quit my job in 96. I was working at the post office. And one of your videos says from postman to stock trader. It was a great video. It has a lot of hits. That's my story. So I started as a postman, but I trade all the time, and I had a pirate radio station. I drive around. I had it all rigged up and stuff. I would trade in the back of it. I'd run home, place a trade. But anyway, that was back in the 90s. And my friends started trading. I opened up accounts for them because I was doing good. I quit. I had $12,000 to my name, and it hit the tech bubble. Perfect. And by 2001, I think I peaked out about 600,000. About 2001. So over the 3-year period, I made went from 12,000 to 600,000. I don't even remember. It didn't last long. 9/11 came around, the whole tech blew up and stuff, and I think I was able to hold on to a quarter of that. It was still pretty good, but boy, man, I learned a lesson there. And it was depressing because you never experienced anything like that, and it's very hard if you've not experienced. You don't know. You're a deer in headlights. So we've never experienced this before, like COVID. We never experienced something like it. We're going to die. It was crazy stuff, once in a lifetime events to happen, a flash crash. We all go through those. So there are going to be times when we lose money, and that's not going to be your fault or anybody's fault. It's going to be just, you get caught, I guess. But anyway, I taught him, I said, we're only taking these trades. And back then we were just not even trading, I wasn't trading this type of trading at all. I was just follow me. I was telling them, don't do anything on your own. I knew what was going to happen. Ends up, about a month down the road, they start not coming to my apartment to trade. They start staying at home. And, within 2 weeks, they all came in here and they blew up their accounts. And they all wanted to just trade. They just so traded. They get in the market and you're just pushing buttons thinking you're going to be in the right way to go. Everyone can do this. You got to be super disciplined, though. I'm not kidding. You got to be disciplined. I'm not fooling around when I say that. You got to be patient and disciplined. You have to be in front of, you have to put the time in too. I mean, how are you going to see these setups unless you're listening to me or something?
One of the things that the first rules I use when I'm traveling and trading, I want to hear your thoughts too, is you have to simplify. And you can't have all your screens with you, and you have to simplify. And also, you're out and about doing things, family, friends, and all that. So I'm really restricted to my phone. And really, the apps on smartphones are phenomenal. I mean, with my broker, I'm really impressed with it. So I can do a lot of the trading. I can't use a lot of moving averages and tools and indicators, and I'm not really a tool person myself anyway. So I focus more on price action and a couple indicators. And that's really my go-to. And really, I also do short-term type things. So if I'm on a train or plane or something like that, I know I can keep it short term, knowing that, the assumption is the Wi-Fi, may cut out at any time. So using stops, everything like that, keep it in place. But scalping seemed to work really well on this trip, and kind of got the bug. Yeah, well, I was there for 14 days, and a typical, China trip. I try to go once or twice a year, and had about, I think, 11 of the 14 days I've traded, and most of them were scalps. I'm a swing trader, but I try to incorporate a lot of scalps in there because you're out and about. And the key, I think, to the approach of scalping while on the road is to know and trust your tools that you have, but keep them simple and really just, like any scalping, strategy, just hit and go. Hit your target, get the hell out, keep them short, and keep them simple. So in this particular example, we've had, I had 14 days of trades. One day I really want to focus on was pretty interesting. I had 3 scalps, total of about 3.5 minutes in duration, right? And, really was interesting. It really made me shake my head saying, why am I sitting in front of a screen all day at home? Yeah, I actually find it, you don't want to make a living on your smartphone, but I actually find it more advantageous in the sense that there's not all the bells and whistles that I'm looking for. So I'm really just focusing on the 3 things in my phone that I'm looking for, and I set it up, is I want to be able to have OCO orders, so I have a stop and a target when I push the button. That's really important, sort of protect my risk management. But when I'm watching it, in the case like a scalping here where you're in and out within a minute or two, you're watching them. So if price is moving in your favor and it should be doing it right away, right? Just move that stop to break even as much as as quick as you can. And again, this is where the tools, when you have OCO orders, or you're able to, when I place an entry, the first thing I'm doing is on my app is going to my stop placement order and ready to move that down. I'm just waiting for that to happen. And then I pretty much just set it and forget it. So have that arsenal with you. I'm not looking at a bunch of other tools. I'm not looking at the daily moving averages and all that kind of stuff. I'm just looking at price action, waiting for the break. And if price, for example, is close to my target and kind of just stops and hovers there, I could just push one button, close it out. That's what we're here to do as scalpers. Just, take it and run. Don't get fancy. Definitely, me personally, I don't trail. I'm not going to be trailing scalping trades. I don't want to make that commitment. I want to hit and run. Yeah, if you're traveling and trading, whether it's for vacation, fun, family, in this case, there's a lot of family things that, in-law issues I had to deal with. That's priority number one. So you use scalping, and this is the one benefit. If you just scalping 24 hours a day, you'll burn yourself out. At least I will. Find the pockets of opportunity and say, you know what, let me see what's going on. And don't break down your barriers. If there's not a valid setup in your plan, don't take it. But chances are, if you look at enough markets, you'll find something. And keep it simple, let it go. But yeah, scalping, you don't really have to monitor and manage. Maybe just moving your stop to break even. But quite honestly, if there's a really quick scalp, you may be out before you have the chance to do it. So, and out meaning target or even stop. So find those little pockets, but don't let it consume you. It will overtake you. And if it even doesn't consume you, overconsume you, you'll probably tick off a lot of friends in the process. So yeah, I think scalping, at least for me, and what I would suggest is sort of like the bonus that you get from regular trading. So I wouldn't suggest making it like your overall go-to, this is how I make a living thing. It's the icing sort of on the cake. That's just for me. If you didn't do too much, I just get tired. And quite honestly, I get a little bored of it, actually, to be honest. But the one thing, if you're considering doing it, is number one, get to know your platform, particularly your app on your phone, and see if your platform, your broker, has the tools that you need to be able to do this. Doesn't necessarily have to be on your phone. There were some trades, a few trades I made on my laptop back at the condo. So, but you get to know it, know OCO orders, know how to execute them, know how to move stops to break even without sort of fumbling through them, because these entries and these trades can move quite a fast, and you want to be able to be quick at your hand, literally at the push of a button, to do it. So first advice, get to know your execution capabilities in your phone. Super, super, super important. The best scalpers say, price came down to my support level at this price with a confluence of a Fibonacci 50% bounce, and I took that little bounce for 18 pips, which is my sweet spot. Like, they talk in math. They think in probabilities and say, historically, that has a 78% chance of success rate, so I got in if I got in at that price. Just talking like math. I love it. All right. When I hear that as opposed to opinions, I say, okay, I want to hear more about this potential scalper. The ability to insanely read markets that they specialize in. Most scalpers aren't jacks of all trades. All right. They specialize in one thing. FX, not even a bunch of pairs. They'll focus on 2 or 3 pairs, and that's all they do. All right. Me, I'm an S&P futures guy. Not easy scalping. That's why a lot of people are not successful at it. But if you know how to do it and have the discipline over time, you could do really well. But you have to know what you're doing. Requires a lot of mental focus. And quite honestly, this is an area where after a certain about time in the day, I start to lose it. And I went to psychology coaches to try and help improve my mental focus. And a lot of the responses, there's only so much you can do. You're human. Like the fact that I'm human, and that's questionable sometimes, but a lot of that is just, there's only so much capacity that your mind can handle. And I've improved in certain things from a psychological level, helped me build that. But after a while, the charts just get to you and stuff. And I'm an early riser, so by like noontime, I'm kind of shifting away from my scalping. And I lose a lot of opportunity because of that. Let's reiterate what we hinted a little bit about in the first course that we talked about on scalping. What are the results telling you? Okay, you want to see your outcome in points and pips, ticks, whatever they are, whatever product you're trading. Make sure you journal them. Was your trade setup compliant? We've talked about this 3 times already. Right? It's so important. It doesn't matter what the strategy is, how successful it can be if you're not executing it with compliance. All right, follow the rules. The setups that I gave you are relatively simple. There's not a lot of stuff going on because most of the time, I design these strategies really because I know you're going to be on a smartphone, a tablet, things like that. You're not going to have all the tools in front of you. And if you do have that in front of you, even better, but actually could hurt you because you get too much into data overload. Keep these strategies simple. Measure your batched results. All right, in scalping, you are going to have variance where some days this stuff just doesn't work. But you're going to have your stops, you're going to take them and maintain your compliance. But over a series and batches of series of trades, you should start to see the results. And you'll also improve personally. So identify what you need to do to improve your execution of these, including the identification itself. Practice in demo only. Again, the cool thing about scalping is sometimes demo can be really boring if you're on a bigger time frame, but scalping, you could just crank them out 8, 10 trades a day if you like. Especially that when screens turn green kind of thing. Look for catalysts that raise the eyebrows. Say, okay, this shouldn't be happening. It's been positive all day and overnight, and all of a sudden we go negative, right? There's a lot of stops, a lot of traders who get frustrated at that level and start hitting their stops right below that area. Well, let's take advantage of it. All right, they're selling. We'll ride that wave as well. Okay, we'll short into that. Let's go to the next slide. So to reiterate, again, you want to be a scalper, you really have to sort of qualify or apply for the job. We want you to get up to a 95% trade compliance level. Can you do that? Well, it starts with making those mistakes and learning from them. Okay, so slowly but surely get you there. Focus on 1 to 2 products and crush it. You do not need to be looking at 100 stocks, 30 pairs, and a bunch of futures, oil, and gold. 80% of my trades are on one product, the S&P futures, and then the other 15% is on NASDAQ, and once in a while, I'll go a little crazy on some commodities or things like that. But as far as scalping, that's how I make my living. One product, be the master of 1 to 2 products, and just crush, manipulate, rinse, wash, repeat. Make the mistakes. Do that in demo, and then you'll learn from them. Okay, when you first start doing this for the first week, you're not going to be crushing, I can tell you. Everyone I've taught, and this does not crush it the first week. And if anything, they're probably confused as hell. But that's why you have a coach and an accountability partner if you have a trader who does that.
All right, so I hope you like this masterclass. So I've got some value out of it. As always, make sure to comment below with your favorite advice from this 1-hour masterclass. There's a lot of stuff in it, but pick one sentence, one piece of advice that you like that makes sense to you, and comment below with it. Other people can like your comment, and you can kind of go through the comment to find a good list of advice that you like. If you want to see the full interviews that we have featured here, the links will all be in the description. You can check it out, and we'll catch you back here in the next video pretty soon. Ciao.